Welcome in, folks. It's the two-piece here today. Two videos only for me to react to. First one up here, serious. BlackRock CEO Larry Fink on his opinions on the market, where you see things going from here, the economy. Some people would say Larry Fink could arguably be the most powerful man in the world that no one knows about, okay? If you're super into the finance community, you probably know who Larry Fink is. If you're outside, you probably have no clue, but some would say he's one of the most powerful men actually literally in the world. Just not a lot of people would even have a clue who he is, okay? And the second video I want to react to is market correction has been around interest rates and valuations, not recession fear, says Cameron Dawson. So I want to hear what her opinions and stance is here. Okay, by the way, we're starting to get into earnings season this coming week here. Charles Schwab reports on Monday, which is going to be an interesting stock to see what happens there. The stock's been getting nailed. You got J&J, Bank of America, Goldman Sachs, United, Lockheed Martin, huge defense play there. Morgan Stanley, Procter & Gamble on Wednesday, Travelers, Netflix, and Tesla all on Wednesday. That's going to be a big day. You have AT&T, you have Union Pacific, which is one of the most important companies in the world to pay attention to if you want to know what's going on with the U.S. economy specifically. Union Pacific, got to pay attention to that one on Thursday. American Airlines, Blackstone, not to be confused with BlackRock. CSX, the railroad operator themselves, you got to pay attention to that one as well. And then Friday, we have American Express, always another important company to pay attention to what's going on in the economy in general, okay? So yeah, big week next week for earnings. Appreciate everybody joining me as always. Thank you for being subscribed, folks. Check out pinned comment down there if you want to see what stocks I bought today. I bought 4 stocks here today. You can get full access to see the moves I'm making each week, the stocks I'm buying and selling in that portfolio. And you also get access to a Discord chat. It's super cheap. Definitely join in there. It's well worth it to see exactly how I build out a portfolio. That's going to be pinned comment.
You on your conference call say you're disappointed because you're a competitive person. Yep. Sorry about the Dodgers. And what I look at and I say to myself, if you're disappointed with these numbers, you're doing everything you can to bring in money. There's really not more than you can do. And it just happens to be the world and where the bonds are that I think are making it so your competition is tough.
Look, as you said, revenues were up 5%, operating income was up 7%, net income was up 14%.
Damn.
We did have some outflows in our precision ETFs, which is a great...
That is super impressive. Why is that so impressive? Okay. It's very important everybody understands what a very impressive income statement is. What he just talked about right there, extremely impressive. When you can talk about your operating income grew faster than your revenues and your net income grew faster than both of them, it's usually a very good sign. You don't usually want to see, unless you're in some sort of super extraordinary growth stock, you usually don't want to see a situation where your revenue, let's say, grows 10% and your operating income grew 2% and your net income didn't grow at all. That would mean you got certainly some sort of bottom line problem, some sort of expense problem.
Example of more people are choosing iShares to trade around, actively trading it. And when market sentiment turns like it did in August and September, and people can see that daily, people should pay attention to the precision. You know sentiment and you see outflows. However, it's up hundreds of billions of dollars in the last few years. So it's every time we've seen this period of time when we see outflows, we see real inflows when sentiment turns. We had one big client in EMEA who pulled out money. It had nothing to do with it. Our normal flows were 95% of the average flows of the last bunch of quarters. And then systematically over the last 12 months, we're up $300 billion in net inflows. And we see a huge opportunities and flows over the next year or so because all the things we're working on. But there is no question we have a better understanding of the texture of what's going on in the market through our ETF platform and our global network. And unquestionably, we're seeing, my barometer of hope and fear with all the geopolitical issues, we're seeing more fear, more people pulling back. And you're actually seeing that in the yield curve. You're seeing the yield curve flatten. Right. And the yield curve is flattening because, people think we're closer to the end of rate hikes. I'm still calling for long rates to be above over 5%. I think the numbers of inflation this week really shows the stickiness of it. We're going to do a lot more military spending as a result of geopolitical issues. We are going to see an acceleration of fragmentation of supply chains because of geopolitical issues, but also as we advance AI and robotics, there is such an enormous opportunity to nearshore, and I think this is all the dynamic. That's part of the dynamics of what's going on in China. When you were talking about China and China's growth issues, we are seeing a recalibration. As I think I said a couple of quarters ago, people are reassessing all their dependencies, and one of the great dependencies that the world still has is the amount of manufacturing assembly in China. Technology is allowing us to recalibrate that. And then we're also recalibrating. You look at the growth rates of India, you look at the growth rates of Mexico, great opportunities for long-term
both.
investing.
I know you know Mexico very well.
Yeah.
India was quite impressive this
And
quarter.
that's where money's going to.
Right.
I was in Japan last week, and the amount of investor interest to invest in Japan is extraordinary. We have a new prime minister in Kishida who has really reoriented the entire economy more business-friendly, business open. They're trying to attract more and more external capital. So we're seeing actually money moving from different locations back into Japan. And Japan has been an area where investors have been systematically underinvesting.
Right.
And so they're now getting...
Interesting. Okay, here's a fun game I'll play, guys. I'm going to Google, how much does Larry Fink make a year? Any guesses before I actually tell you guys? How much does Larry Fink make a year? How much, or let me just type in Larry Fink salary, and we shall see what it is. This should be interesting. So Fink's total compensation last year, man, poor guy. He had a big pay cut last year. Only $25.2 million last year in total compensation. The previous year, he had a compensation of $36 million. So, dang, big pay cut there for Mr. Larry Fink. But I think he's doing okay for himself.
But you make the point of the generational opportunity in bonds, but you just said about the 30-year. Now, I found myself looking at portfolios because I have to invest.
Yeah, it could be true, a generational opportunity in bonds. I mean, bonds haven't done anything for years. Like, literally, bonds are down for, the last 5 years or so? Look at the TLT. I don't know if we've ever seen this big of a crash in the TLT in history, to be quite frank. I mean, have you guys seen TLT? This is extraordinary. I really don't know if we've ever seen the TLT be in as bad of a spot as it truly is. Let's see here. TLT. So let's go back all. My gosh. Yeah, I don't think we've never seen a crash like this in TLT. We've seen certainly some painful down moves in TLT over time, right? You know, this was kind of around the great financial crisis, certainly there. Even prior to the great financial crisis, you had some big moves down. This is kind of around 2012, 2013 there. This was 2016, 2017. You certainly have some big down drops, but nothing like what we just witnessed here. Look at where TLT was freaking July of 2020, and look where this baby's at now. I mean, it's back to the same levels you saw, certainly prior to the great financial crisis. Yeah, that's extraordinary, folks. And so, is a TLT an opportunity? Probably. Do I necessarily want to buy TLT? No, because once again, it gets into, it's not just about, you got to remember a very important thing I've got to explain here to everybody, okay? When you're investing, as an investor, it is not just about, can I make money in something? Because you can make money in so many things. There's so many ways to invest and make money. It's not just about, can I make money in this thing? It's about, is this the best place for my money? So I stay diversified, and so I can get hopefully a great ROI on that very low risk as possible, with as much return upside as possible. Okay? Because you can go make money at the bank. Put your money in a savings account or a CD account. You can make money in treasuries. There's a lot of stocks out there that are going to be tremendous performers over the next 3 to 5 years. I mean, crazy performers. There's a lot of dividend stocks you can make dividend cash flow money from. So many opportunities. But where's the best opportunity? So when I look at something like TLT, I say, is it a moneymaker over the next few years? It could be. Is that the best place for my money? In my opinion, no. Because I can make money a lot of different ways, right? So just something always important to just keep in mind what I just said right there.
I can invest in bonds, and I was very attracted to, candidly, to the high yield. It just seemed like a great opportunity. But I don't know where that's where you would prefer someone my age. Who's interested in that, and who should be?
As rates go higher, you're going to see more immunization of the old defined benefit plans to lock in. As liability rates went up, we are seeing more and more pension funds, more corporate funds that are actually match assets and liabilities. And so they're going to be able to immunize the volatility. And that means they're going to be selling out of equities, buying more long bonds. And that will happen. It's not happening yet. But let's be clear. If you could start earning 7% on credit, if you could start earning 10 to 12% on infrastructure investing as our Infrastructure Act going in, as our IRA starting to be implemented, these are going to be good, healthy, long-term investments that are going to be, anywhere from 8 to 15% returns with high probability of success. And so that's where a lot of money is moving.
Okay, it's like, Carl, when I was talking about how the rich people come on and there's like basically it's perilous forgetting, this is what I'm talking about. That's the opportunity.
Correct.
And people who are listening should say, you know what? In this time of peril, did he just say I might be able to get those rates? That's pretty darn good.
And, right now we're facing a lot of headwinds on geopolitical issues.
That's true.
Hamas invasion of Israel, the horrific acts. That creates a lot of fear, and people are actually pulling back watching this. At the same time, and the headlines of every newspaper, every website is about the fear issues about the world.
Yeah.
But if you overlay the opportunities in investing in AI and robotics, the opportunities in nearshoring and recalibrating supply chain. Now, if you overlay, because you were talking about the healthcare companies, now if you overlay the incredible transformation in with Ozempic.
Before he goes further here and starts talking about Ozempic, the most talked about thing, I swear, on freaking CNBC recently, maybe in the market in general, I'll answer a question for you. The question you might ask is it a good time to invest if there's problems in the Middle East? Okay. And what I can tell you based upon data, it is. Based upon data and me looking back at, all the different issues in the Middle East over time, the returns over the next several years, as there was problems going on in the Middle East, were actually pretty extraordinary. And I showed a whole chart of this actually on the main channel probably, how many days ago was that? It was maybe 3 or 4 days ago. I actually showed you a chart in that video on the main channel exactly going into detail how the stock market did, basically in different scenarios in which there was, let's just call it, big problems in the Middle East. And so, and at the end of the day, the Middle East has been quiet here for a bit, but you got to understand the Middle East has always had a lot of issues. I wish someday it could be, all peace in the Middle East, but the Middle East always has issues. There's always problems between different groups, and it gets violent, and it's really nothing new. It's the same thing that's been going on for long before I was on this earth, I can tell you that, and long before anybody that's watching this video right now has been on this earth, okay? I can promise you that. And it's probably going to outlive all of us, just to be quite frank. I wish there could be peace in the Middle East, but to be honest, there'll still probably be problems in the Middle East even when we're not here anymore, anyone watching this video right now. So it's just the way it is.
Other items, what it's going to do for longevity of life.
Yes.
Okay, this week we discovered that these drugs can help in renal failure. They can help in other things. Now, if you overlay that and like Eli Lilly's drug for Alzheimer's, that extends the pathway by at least 40%. This is creating hope. And so a lot of people ask me, why isn't the market collapsing? Okay, because of all of this. We're not spending time talking about these opportunities of, there is incredible medical discovery that is elongating life. We have great recalibration of supply chains that's going to bring jobs here, opportunities here in the United States, in Mexico and India and other places. So, we're spending so much time on the negatives, but all of this just tells me why you need to continue investing.
Yeah. Well, Carl,
these are the opportunities.
We spend so much time talking about the fact that we're not going to eat sugar cereal. Maybe we should talk about the idea that maybe our average lifespan is going to be 75.
But, think
there's a different mentality that somebody like Larry Fink has. Who do you think Larry Fink's talking to all the time? You gotta ask yourself, who is a certain person communicating with all the time, right? Larry Fink's gonna be talking with, everybody that comes in contact with Larry Fink is gonna be stupid rich, right? These folks have a very different mentality than, let's say, an average person, right? An average person is going to get caught up a lot more in the negatives, right? In all the things going on in the world and the realities of things that are facing them in their lives, as well as things that they perceive as realities that maybe aren't realities, but they've been brainwashed certain ways from, certain things they see on social media. Certain news networks have got them to think certain ways, and it becomes their reality, right? Reality is really just what you make the reality, right? You could perceive this world as a great place where so much good is done. You can perceive this world as a bad place where just evil is done, right? You can see this world as a very positive place, and there's people on this earth that see this place as a very negative place, right? You can believe whatever your mind wants you to believe, right? And so Larry Fink's just in a different group with different folks, and they just think differently. And how a rich person thinks is a rich person thinks about opportunities. They think about the risk, they calculate that risk, and then they think opportunities, calculate the risk, opportunities. That's the way they play it, right? That's the way a high net worth individual plays this game. You just got to ask yourself, how do you want to think? Do you want to think like the average person? You can choose to take that mentality, or you can start to format your mindset like a rich person was, and you'll start seeing a lot of, let's just call it, improved results in your life. It's just a very, very different outlook on once again, is what is reality and what is perceived reality.
What that means, though, getting back to long duration bonds, so if we're going to be living longer, are we being prepared properly? And if you can start locking in, 7, 8, 9% for 10, 20 years, that's going to give you a lot more confidence and dignity in retirement.
Even that thought process there, right, about potentially living longer and Ozempic and what the, results can be from that. Even that, there's no average person, considering that and, having discussions around that. Larry Fink and people around him are actually calculating how this is going to affect future generations and how it's going to affect future economies and where opportunities will be and where opportunities won't be and how that changes healthcare space and how that changes this and that. Those are just different thought processes that average person is just not even on that wavelength.
It's themselves. They think they're going to make it to 72. They should be thinking that they can make it to 85. They better have enough money when they get there.
I think that is going to be the biggest societal risk.
Yes.
And I think, look, we're seeing more death because of drug abuse. And so that's bringing down our longevity rates, all those type of issues.
Right. That's true.
And so if you make it to 60, you have a higher probability of making it to 80 and 90 and 100.
That's true.
And so the statistics of the declining mortality rates are hiding some of the real upsides. And I'm not trying to dismiss some of these tragic medical problems like, drug abuse but we may be solving obesity, which
That's
is
freaking great points. And how many people are even thinking about that? How many people are even talking about that? In regards to life expectancy, right? That's crazy.
Major problem of so many of the problems, and so I'm more optimistic than ever with the overlay that in the short run we're going to have to face some near-term issues.
Right. Do you think that means the median age of the marginal equity buyer rises?
Yes.
Where you'll tolerate risk later in life?
I am, and I'm older. There's no question. I think the traditional reallocation, I think the 60-40 type of thing, I think, for a long-term investor, long-term view, who can tolerate market volatility, you should be at least 80% in equities or hard assets.
Amen.
It could be real estate, it could be infrastructure. And if you could really tolerate it, in my mind, you should have been 90%, 100% in equities. Now, a lot of people can't afford that.
Wow, that's a pretty shocking comment there. That goes against what most financial advisors would tell their clients right there, okay? There's 60-40, 60% stocks, 40% bonds. And he's basically saying, no, he's basically saying you need to be in actual equities a lot heavier than that. He's talking about 80, 90, or 100%, right? Which is exactly what I believe as well. But it really goes, are you looking for outperformance or not? I would much rather hold the best companies in the world with some of the best CEOs, right? in some of the best, income statements or balance sheets out there, and some of the best growth profiles and opportunities, and have my money be placed there versus this other stagnant thing that it's like, I don't know. Okay. I'd much rather place my bets on the best of the best, because what I know is the best of the best at business are going to find a way to bring a whole lot more money to you over time than ultimately the money you invest into them, right? And will you be wrong sometimes? Yes, you're going to be wrong sometimes. Will you have to take losses sometimes? Yes, you will have to take losses sometimes. Will those CEOs you thought were going to do good sometimes do bad? Yes, that is what it plays out. But as long as you're diversified, right, and you play your cards right, and you care enough, and you pay enough attention, and you study enough, the risk is nothing compared to the reward potential there, right? And you can get through all the tough times and the bad markets and, oh crap, this CEO really dropped the ball and they screwed up. That's part of the process.
It's a radical view, and yet it's an empirical view.
It proves out. You got to have a 10, 20-year view. Okay, I'm a hopeful person. I believe that in 10 years and 20 years, humanity is in a better position than it is today. With that view, I want to own hard assets. I want to own equities. I want to be a part of this economy.
Yeah, you can go back over time, right? Talking about hard assets, whether it be stocks, whether it be real estate, whatever, right? Always a view of like, it's going to go down, You talk real estate, right? Let's talk about the real estate market. We talk so much about the stock market all the time. How many times have people come to you and said, I'm going to buy when the market crashes, when the real estate market crashes, when home prices go down? If I had $1 for every time I've heard that in my lifetime, ooh, man, are we talking some money there, right? Always like, I'm waiting for the housing market to crash. I'm waiting for that. And people keep waiting, and then prices go up over time. Then they stagnate for a bit or even go down. And like, no, I'm waiting for it to go down a bunch. And then they keep waiting, right? At the end of the day, where are real estate prices going to be a decade from now, right? Where are real estate prices going to be 20 years from now, 30 years from now? I would guess a lot higher, and especially if it's talking about any city that's going to continue to attract a bigger and bigger population, so there's more and more of a need for housing, okay? You buy homes in great communities, in great cities that are growing cities, prices are going up, and they're going to go up a lot over the next 10, 20 years. Will they go down over the next 12 months? Potentially. But to try to predict that is a damn hard challenge. And people try to predict that crap all the time and then come up short again and again and again. And then home prices rise another 10%, which a 10% rise in a home price on a $500,000 home, it's $50,000. It's not a small amount of money, right? On a $500,000 home, 10% rise is $50,000. So then that home rises again and again and again, right? And, people just are losing that appreciation you get there. Because you got to remember, when we're talking about a house, that appreciation is massive. Even a few percent is a big number. A big number. That's what people miss out on. They get so caught up into trying to time the thing out, and I'm gonna wait to buy myself a house until ... happens. You've got to understand the risk you're taking there is insane, right? Like an insane risk to stay on the sideline and keep renting and throwing the money toward rent versus buying. So these are just all things to consider, right? I appreciate Larry Fink's, not just kind of his outlook there, which I thought was interesting, but I just like to listen to somebody like that. How does he think? Super high net worth individual, surrounded by nothing but high net worth individuals. Like if you get a meeting with Larry Fink, you gotta have stupid money. You gotta have 9 figures plus. If you don't have 9 figures plus, you're not even talking to Larry Fink, okay? And so these are people that are running the world. This is the way they think. This is their thought process. And it's just very, very different than what you're going to find from certainly a lot of folks out there. But I can tell you, those folks didn't get to those sorts of numbers by having a different thought process. They always had the same thought process, right? And they went out there and executed on it. All right, next one up here. Market correction has been around interest rates and valuations, not recession fear, says Cam Dawson.
Quarter earnings. We want to bring in Cameron Dawson. She is Chief Investment Officer of New Edge Wealth.
There she is.
Cameron, what do you think of the reports we've already heard this morning? It sounds like just about everyone.
Always perfect makeup, always perfect hair. People think I'm trying to hit on Cam. No, I'm just giving respect where respect is due. I mean, it's the hair's flawless, the makeup's flawless. Like, you got to give somebody kudos. It's no different than a guy. Guys give guys compliments all the time. Oh, those are nice shoes. Oh, man, I like your fit. Oh, nice haircut. All these sorts of things, right? Like, so you can give a guy compliments as a guy, but you can't give a woman compliments? What's wrong with this society? I don't know what's going on with you guys. I don't know. You're getting a little different.
If not all of them, have beat expectations this morning. But if you listen to the commentary, there are some signs of concern about what comes next for the economy.
I think that is exactly it. There's a lot of blocking and tackling this quarter. You see by a name like JP Morgan still able to do an 18% return on equity just shows you that even in a challenging time, they're still able to be very profitable. But then the question is, do times get even more challenging? JP Morgan talked about how consumers are starting to spend down their cash balances, that they're not at a point of reaching the full exhaustion of their spending capability. But of course, banks are very aware that if consumers continue to get pinched by inflation, things like higher oil prices, you've spent down the cash balances, how many more levers can you pull for the consumer to be the sole driver kind of upside surprise for this economy, which is
why we need in 2024 inflation to not be a factor. If we can get inflation not be a factor, people are able to keep their jobs and be able to make, the same sort of wages they're making now, or maybe even a little more. Then we're talking about the consumers in a far stronger spot in 2024 versus 2023 and 2022, when they got sliced and diced by inflation and wages were kind of playing a catch-up game. Because don't forget, wages have been playing a catch-up game here, which is why you see all the unions striking and all that stuff going on this year in 2023. It's a big catch-up play. So it's just important to remember the consumer could get in a much better place in 2024. It's not a guarantee, but it's a potential, and it's something that has to be considered, as well as the downside scenarios, right? Everybody considers all these downside scenarios. Oh, consumer doesn't have any money, they're going to lose their jobs. Well, right now the consumer has their jobs. Inflation has become less of an issue. If it becomes a non-issue in 2024, you could be looking pretty dang good.
Question going into 2024.
So where do you come down on all of this, Cameron? We had seen this kind of pressure on stocks that brought things down, real negative sentiment, but that's kind of reversed over the last 5, 6, 7 sessions where people are thinking maybe the sell-off was too much. What camp are you in?
Yeah, we thought that some sell-off was very likely given the seasonals, but we're starting to see this pressure when we've returned down to the 4,200 level in support of the 200-day and rallied back up to that 50-day moving average, kind of losing steam, which just means that we're likely in for some more sideways chop. When we think about the messages the market is sending us, one of the most important things that we're watching is how consumer discretionary stocks are performing versus consumer staples. That actually is a really good indicator about forward growth expectations for this market. And I think one of the most interesting things is that ratio has held up surprisingly well throughout all of this correction, which brings us back to a point that maybe this correction really hasn't been about growth fears. It's been about interest rates and valuations, some kind of digestion of that, instead of this rising fear of an impending recession.
All right, well, if it's about higher...
I have trouble recording in this room because out of this room I have multiple windows I can see out of, and I see everybody driving by and stuff. And I just get angry watching people drive. I'm like, this person's driving too fast. And I'm like, this person, they're driving too far over that way. They could hit somebody and they could hit another car. I'm just angry, man. So I need to not look out these windows when I record.
Interest rates. Get ready for some more indigestion, potentially. You're right. We've seen stock prices come up as the yields on interest rates came down over this last week. Jamie Dimon, though, says he would not be surprised to see interest rates higher from here, just given...
I actually didn't get to see market close today. So let me see where everything closed out at here today. I've gotten used to doing the new Twitch show, so, and I don't do it on Fridays. All right, let's see what actually transpired here today. Wow, big pop in the VIX here today, folks. Big pop in the VIX. Check out that baby. VIX up 20% today. No! Crude oil! No! Oh no! Crude oil up almost 6% here today. Flip my flapjack on the floor. No, we cannot have that, folks. We cannot freaking have that. GSG, commodity index in general, is up 3%, of course. Like, if you're talking about, crude oil's up that much, no. As far as stocks I own, Honest had a surprisingly big upside move there. JP Morgan only finished up 1.5%. That's not good. That stock was up way more than that. It gave back all the gains. Avant, little gain here today. Target, Texas Roadhouse, Mattel. Elf, Foot Locker was green. Everything else was red. Planet did the worst of the bunch. WBA did second worst, came off a really good day yesterday. Win, third worst. Shopify, fourth worst. Oh, wow, even Palantir got hit today? Palantir? Are you kidding me? Wow. Okay, let's see what happened in big tech here today. Big tech. Oobity Booba stock got hit over 5%. AMD 3.4%. Oh, wow. NVIDIA got hit over 3% here today. Tesla was about a 3% hit. Meta was about a 3% hit. Interesting. Let's check out safety stocks. Did we see some rotation into safety stocks? And the answer is a little bit, but not much. Not much. Dollar General was obviously really good because the CEO transition there. You did have Campbell's Soup up pretty good here today. Kellanova came back a bit. General Mills up 2%. Kraft Heinz up 2%. So, yeah, a little rotation there, but not what you would want to see. What about the slaughterhouse of fintech? Let's see. Yeah, it was a slaughterhouse. Square down over 5% here today. Affirm down over 3%. SoFi down over 3%. PayPal down 1%, but it's $55 now. The pricing on PayPal now is shocking. We're into shocking levels with PayPal. Doesn't mean it can't go lower, as we saw with Meta. Meta was shocking levels last year when it dipped under 120, right? And then it went under 100. It went all the way down to $88. So, PayPal's at those sort of shocking levels now, but doesn't mean it can't go another lay lower. You never know. You never freaking know. But man, it's been a just shocking move down for PayPal. I mean, it's still in the slaughterhouse. Housing stocks here today was a mixed bag. You had Redfin get hit 3.4%. But then you had KB Home was the best one in housing stocks stay up 1.5%. RH was down, Whirlpool down, Home Depot down, John Deere down, Lowe's, Caterpillar, Rocket down. You had a lot of those REITs down here today, and Zillow down, United Rentals down. So, yeah, a little bit of a mixed bag in the housing stocks here today. Let's see the travel sector. Ooh, travel sector got hit hard. Oobity Booba stock down over 5%. Wynn down 3.5%. RCL down 3%. Delta down big. American Airlines down big. United Airlines down big. CCL down 2.7% here today. Man, CCL, is it really going to hit $11? CCL is starting to tempt me, folks. It really is. I don't know if I can make a move in CCL. It hurt me a few years ago, but I might. I don't know. Airbnb got hit. MGM got hit. Hawaiian Airlines is now under $5 a share, folks. It's $4.91. Southwest Airlines is down to $25. Okay. Interesting times in this market. Now, do remember, folks, today's October 13th. Do remember, the market bottomed last year for almost all stocks, between mid-October and the beginning of November. Almost every stock I possibly kept track of last year, especially all the tech stocks that have been wrecked, almost every single one of them bottomed, other than maybe Tesla, bottomed between mid-October in basically November, including the indexes as well. If you go back to the indexes last year, you're going to find they all bottomed right around this time. I can pull you up the NASDAQ last year. Let's pull you up the NASDAQ and show you exactly what I'm talking about. So let's go. Let's just pull up the Qs here, okay? QQQ. Let's pull up a 5-year here and see where this baby bottomed out. So right there, the week of October 10th, you saw the bottom for the Qs last year. And then you saw kind of like almost like a double bottom in December. So we had a nice rise. Then the market fell again going into December. Maybe that was tax loss harvesting going on there in the Qs. Certainly, there was a lot of money to be tax loss harvested there. So now if you don't see a kind of a bottoming out in the indexes over this next week, that could maybe smell a little bearish, okay? Because this is the time period it happened last year. We need to see that kind of play out here. If you don't and you keep weakness going into November, then you're in something different, okay?
Everything that's going on around the globe, if you look at potential for the strong job market that we're seeing right here in the United States, and then what to anticipate from the continuing war in Ukraine and the attacks on Israel this week, that all of that could add in to additional inflation, meaning that the Fed may have to raise rates.
Yeah, and he also called out those record peacetime deficits, which is really important because we're seeing this big increase in supply of treasuries that's not being taken down very well. That's what we saw yesterday with the treasury auction going rather poorly for the 30-year. And I think the interesting thing here is that if you even look at the Congressional Budget Office projections for 2024, they have a little bit of an improvement in debt to GDP, but it really isn't that much of improvement. Still about 6%, which is very elevated given the fact that we're still in a strong GDP environment. So what happens if we do enter a recession, GDP falls, and you have to spend more for more countercyclical measures? Where do those deficits go? What does that mean for Treasury supply? And then what does that mean for Treasury yields, which could still be biased higher?
That's a good point.
So, Cameron, what do you like when you look around? I mean, that's...
The only critique I would say with Kim's makeup is I do think she should maybe pick a little darker shade. I think she goes a little too white.
A lot on either side of the ledger for the Bulls or the Bears. What do you come out?
She should almost be going a little, see the difference between Becky Quick and her? I think a little more toward the Becky side.
Yeah, we've been liking this pair in the sector standpoint between technology, which still has very strong trends. You don't want to fight it. We still have very strong earnings growth within technology within 2023 and even looking in 24. And then pairing it with something that's a bit more value, cyclical value like energy. Energy has the worst earnings growth in 23, which does set you up for some pretty easy year-over-year comparisons. But if we start to see oil prices continue to rise as they are this morning on geopolitical risks, that's an area where if the rest of the market does not like those oil surprises simply because it would exacerbate inflation, energy would do well. Energy is a very cheap sector as well. You've also seen a lot of outflows from that.
Yeah, the problem is the higher energy stays, the more risk it is to the economy, the more risk it is to the economy, and the more risk you have a recession. The more risk you have recession, the more likely you are to see an absolute collapse in the price of oil. So what might seem good on surface level is not actually as good as it seems for oil.
So we like the highest quality names within the sector, names that generate a lot of free cash flow, don't have too much debt, but we think it's a sector that was left for dead in 23, which could set it up for a much stronger 24.
Interesting. Okay, so I definitely enjoyed hearing her thoughts there, folks. Yeah, I would love to hear your guys' opinion in the comment section. Big earnings season, obviously. If we want to talk about getting this market back focused on stocks and what's going on with companies, earnings is everything, right? The market is very distracted right now. What's the Fed going to do? What's going on with, 10-year treasuries and 2-year and 1-year and all this stuff, right? What's going on with the 30-year? What's going on with the TLT? What's going on with the Middle East? The market's focused on everything but earnings, right? And what's actually going on with companies. So the market needs this earnings season more than anything, because then the conversation starts to switch to, did you see the revenue that company reported, the net income, the guidance, the conference call? That's what we're about to get into now, and that's the most helpful thing for the market. And that's honestly probably why the market actually bottomed around this time last year, as you got into the earnings season, which is what is needed in this market, I can tell you that. Appreciate everybody joining me as always. Thank you so much for being here, folks. New all-time high subscribers in the history of the channel. Appreciate each and every one of you. And also, get in my Patreon. That's going to be pinned comment down there. You want to see the stocks I bought here today, as well as, in future days and weeks, as well as stocks I'm, selling, why I'm doing it, things like that. I even record you guys a private video in the Patreon here today, which almost never happens. So make sure you join in there. That's going to be pinned comment. Much love and have a great day.